I'm a big believer in working. You could work harder for 4 days a week. You can work 8 to 10 hours, 4 days a week, have your 3-day weekend. And now with this, there's just going to be a lot of bad sentiment, bad vibes, and you can already see it on the road. It's crazy.
Welcome to the Ottawa Real Estate Podcast. Join your hosts, Paul Stevenson, David Warren, and Greg Campbell, as they explore the world of real estate and mortgages. From the heart of Canada's capital to markets nationwide, and even a little beyond. Get ready for expert insights and hot topics. Let's get started.
We are back. It's the Ottawa Real Estate Podcast. Hello.
Expert insights.
Expert insights
From the experts.
The experts. Guys, we got better feedback this week from the show. We got a lot of love. I know we were talking about the hate. We got to give a shout out for the love. A lot of love.
That's surprising.
That was good. It was good. I felt last week.
I'm used to just all the hate. That's all. I'm just used to all the hate.
Yeah, well, the hate's usually the loudest, as we know. Yeah. So we felt the show last week was a bit flat. Seems it wasn't. So I'm happy to say that we're ready to go this week. We're all dying. We're all sick. We're all trying to make it through the day. But how was the week, gentlemen? How are you guys doing overall? What's up?
Overall, decent. I'll get straight into some overall about the week. Real estate, properties not moving. Many more properties coming on the market daily. Many not selling. What does that mean? Not sure. Next couple of weeks are going to be wild.
Yeah, actually, I think it's B. Charon, but the Charon Family Connect on YouTube actually had a great comment. I'll just lead off with this. It says, so housing starts are down. Mortgage amortizations are up. Rates are coming down. Population's still growing faster than starts. And you guys expect more supply to continue to outpace demand. For how long is the question?
Mm-hmm.
For how long? What do you think?
Well, we're definitely not. The supply is definitely not there. I know things are sitting right now, but that's, again, we've talked about it before. By and large, housing starts in Ottawa are down, or like 20%. I think we were just talking about, Greg, I forget the stat you just mentioned, of what they were expecting within Ottawa. Again, speaking to Ottawa, but it is an issue national where places aren't being built. Yes, there's supply on the market. There is places sitting, but that's more so psychological, that people are just staying in their rental or their parents' basement for the time being. But yeah, I'm kind of have been waiting for that shoe to drop a bit, but I'm curious if, obviously nothing's really picked up that much from the latest rate drops with the U.S. Feds dropping significantly. I'll be curious if the end of October decision is kind of following suit with the U.S. of a 50 basis point drop, and if that plays any impact to people's mentalities.
Yeah, kind of what I was saying last week too is, it's great news that interest rates are coming down, but that's a sign that the economy is not doing well. Like it's not a good thing at a grand scale. It means that things are bad, so they have to drop rates to ease the pressure on people. So if this hasn't helped, as you said, like the expectation, I will say though, lots of conversations about variable this week. Like it's definitely almost every client now, when the conversation comes up about rate, there's at least, most people still lean towards fixed after you kind of go over everything with them, but the variable is certainly a very good option, and more so now because with the expectation that rates are going to continue to go down, you can kind of take that higher variable rate now with the ability to convert that into a fixed rate in a year's time or 6 months when rates kind of keep dropping on the fixed side. So I've had a lot of conversations like that with clients where they're thinking, okay, well, we could take, a low 4 fixed rate right now, or we could take a variable rate kind of in the mid to low mid fives, with the hopes that the fixed rates continue to go down and then convert it in 6 months to a year and kind of take advantage of that, 399, 379, whatever that looks like in the coming months. So definitely more conversations happening since the last rate drop, more than I've had in the last probably year on the variable side of things. So that's always interesting. And I think that'll probably continue, especially if in October they do a quarter point or half point drop. That'll just accelerate those conversations.
And it's crazy because I think there's a lot of people just waiting to see that half point drop. And I don't even know what's going to happen with that. And I tell my sellers that, I'm like, listen, they go, this is one of the reasons. I go, It just happened that we listed at this time. So if you want to compete, we're going to have to bring the price down, because I already know in communities where we have properties listed for sale that there's other ones coming up and they're listing at the same price. It's like in Orleans, there's townhomes. We've got one on at $650. We were, I think, one of the first 2 weeks ago. And since then, there's been, I think, 10 that have come on almost around the same price. There's been 4 that sold. They probably should have been around $675. They listed at $650. They sold in a couple of days. Some had multiple offers, right? I don't know if they sold for over or not yet, but it's challenging. And I know of more coming up now. So I told, one of my clients, I said, listen, you guys are going to have to drop it, because we can't, if we want to compete, or else we're just going to be the statistic of another one of these homes waiting and then dropping later, which is unfortunate. But I wanted to touch on quickly, I mean, this probably could have waited till in the news, but Dave brought up the 22% thing. So we're only at 22% of the goal set for the year of new home starts. So we were aiming for 15,000, right? So we're only at 22% of that, not even close. So the real issue with population growth and affordability concerns, it can't keep up. Prices will stay high. Maybe. Will that happen? Who knows what's going to happen in the next little bit. But I can tell you one thing. One of our agents, Venkat, he had some clients looking at a specific new build that he's been keeping an eye on with a walkout basement that Minto put out. And they went and they drove by the Minto Center, sales center, and they did that at 4 p.m. last Saturday, I guess it was, or maybe it was Friday. 4 p.m., there was 5 people sitting in line, waiting, sleeping overnight. His clients did the same, and they got the lot that they wanted. And then the people that came in after, it turns out they wanted the same one, so they just got it. So they were very grateful that, Venkat, he called me, he said, he just explained to me, and I said, man, I haven't seen that since when, the last time that happened with the new builds, when realtors were basically just shut out. We weren't able to even get any commission. Even if we'd been working with clients for 6 months, they suddenly wanted new. We were totally pushed out because the builders had top priority. People were waiting in line. There'd be like hundreds of people waiting in line overnight for even 2 days in some cases to get these. So seeing that was interesting, especially knowing that the new home starts are down, way down. Does that mean that these new builds, now that they're priced more competitively and beating out the resale market, is there going to be more lineups for the releases that they put up from maybe even 4 to 10 lots at a time? Venkat said there was about 50 people in line by the time the morning came around to get in there, and there was only 10 lots available.
I was going to say, I actually saw a video from a realtor in Ottawa that driving by and posted a video of the people that had been sleeping overnight for those lots, which, yeah, certainly interesting, brings back memories.
Remember that? That was
COVID days.
I remember that one release in Barhaven, I think there was 400 people in line for 2 days.
Yeah, a Kaivan release, I think it was.
Ridiculous.
Yeah.
Well, let's not forget about the lotteries.
The lotteries, that was crazy.
Yeah.
I knew someone that I worked with someone that won the lottery. That was ridiculous.
Yeah, I'd put
winning the lottery without winning the lottery.
Yeah.
Winning the lottery. Anyways, I think without further ado, let's get in the news.
Let's get in the news. In the news.
Are we just going to get into that one hot topic that we got? That one hot topic? You want me to start with that
right now?
Back to work thing. You want me to get going on that?
Back to work. So hot right now.
Let's get going. We got a little summary and some questions, guys. I want everyone to, and please, listeners, viewers, chime in after this. So the shift toward returning workers to the office in Ontario and Nova Scotia is set to significantly impact the local real estate markets. In Ontario, particularly in urban centers like Toronto and Ottawa, we may see a surge in demand for city properties, both for rent and for purchase. As workers relocate closer to their offices, rental prices could rise, and the condo market, especially in business hubs, may experience renewed interest. Meanwhile, rural and suburban areas, which saw increased demand during the remote work era, could see a slowdown in growth or even a slight decline in property values as fewer people work remotely full-time. In Nova Scotia, particularly Halifax, there may be a similar increase in demand for urban housing as workers return to physical office. The pandemic-driven influx of people moving to rural Nova Scotia from larger provinces like Ontario may slow down stabilizing housing prices in rural areas. Additionally, as companies bring workers back, the demand for commercial office spaces in key business areas like Halifax may rise, prompting to potential commercial real estate investments. The transition raises several important questions about the future of real estate market in these provinces. Now, the thing that made me attracted to this article mostly is that in Halifax, it's not just like Ottawa where it's 3 days a week. In Halifax, it's 5 days a week. You got to go back full time. And that goes back to even people that were working from home part-time or remotely part of the time in 2015 before the pandemic. It's like you have to come back or basically you're losing your job or something like this. And this is non-unionized workers. So they're either going to have to go somewhere else or do as they are told. So, you know, the question is, how do we think the demand for suburban and rural properties will change if these companies implement hybrid work models rather than full-time return to office? And could the rise in demand for urban housing in Ontario and Nova Scotia lead to increased competition and affordability concerns, particularly in Toronto and Halifax?
Yeah, I think I was actually reading someone online telling a story that during the pandemic, they moved to Port Hope. They worked in Toronto, moved to Port Hope, were working remotely, bought a home, settled in. 3 years later, back to the office in Toronto. And obviously vacancy, like rent is through the roof. Unemployment is up in Toronto. The cost of everything to even just get to Toronto is through the roof. So this person's in a position now where they're probably going to have to sell their home or find a new job, obviously being that far out of Toronto. But I think just in general, there's a lot of back and forth, especially in Ottawa being a very prominent government town where a lot of these people are having to go back to work for the first time in a few years. And, you know, on the flip side of that, Ottawa basically consists of government workers or self-employed individuals, mix in a sprinkle of high tech in there. Actually, it's probably a lot of high tech, but either way, a lot of these self-employed individuals or business owners are, you know, have been suffering as well because of people working from home and not being in the downtown core and these other areas where there's typically business centers and so on. So there's kind of this back and forth argument right now that, you know, government workers are feeling like they shouldn't have to prop up the businesses and in the kind of downtown core, but at the same time, those businesses are happy to have the people back in the offices, and it's kind of back and forth. So it's very interesting in Ottawa specifically. I can't speak for Toronto or how it's going to impact the housing market, but it just made me think of that woman in Port Hope that is now having to basically relocate. And I think a lot of people did that. They relocated out east or wherever just because they figured, oh, well, this is going to be indefinite. I can just work remotely forever. And now, you know, the what do they say? The rooster's going back to the hen house, or what's that term?
I don't know, but I like it.
I know, not even close, but I mean, I actually had a few clients that during COVID had bought in the valley outside of Ottawa, and even, you know, closer to Prince Edward County, and had to sell within under 3 years because they were told they had to go back to the office. I think the kind of discussion that I keep hearing in the news about, you know, the return to work, and obviously it's been on for 4 years, basically, that none of these people have had to work in an office. So that's throwing them for a loop, but they're not used to that morning commute. Like you see it on the highways. It's like Tuesdays, Wednesdays, Thursdays is when they're all going to the office because they want the extended weekends though. But they're also, I talk to so many government workers, and this is something that most aren't talking about, or other people, but a lot of them are doing second jobs while they're supposed to be working.
Yep.
Like full salaried for government, which is our taxpayer dollars, and supposed to be working at that, but they're doing something else, or they're grocery shopping during the day, doing their laundry, like this, that, which again is like, I mean, that's, as taxpayers, that is our dollars. So I think there's that argument for a lot of people is obviously the commute sucks, especially when you haven't had to do it for 4 years, but also for people that are wanting to, you know, that convenience is gone, which I think is kind of.
And I'm saying, man, like regardless of productivity based on, you know, the typical government worker who we know personally, many who say exactly what you said, I believe anyways that it's a mistake for just humans in general to be forced back to that when they're probably producing more, living a happier life. Producing more, being more productive, getting more important work done quicker, you know what I mean, remotely, better, they're in a better headspace for their family. You know, I'm a big believer in working, you could work harder for 4 days a week, you can work 8 to 10 hours, 4 days a week, have your 3-day weekend, and now with this, there's just going to be a lot of bad sentiment, you know, bad vibes, and you can already see it on the roads. It's crazy. You forget when you don't see that for so long, and now that you see it or you're sitting in it, it's just like, oh yeah, okay, this is what it's like. and it's not fun unless you're leaving your house at 5 a.m, and then you're all good, you know.
Yeah, I see both sides. I agree with both of you. I think also it's very important for humans to have like human interactions as opposed to just sitting in their home office, 40 hours a week. But that commute and the time that you spend, if you're spending an hour on the road every day, like you said, Greg, that's an hour you could be spending with your family, getting groceries, doing your laundry or what have you. But like anything, there's going to be bad actors. Let's say it's a small percentage of people that are abusing that ability, as you said, Dave. Like they are working at home, but maybe they're doing Uber Eats during the day, or they don't have to check in, or nobody's kind of keeping an eye on them, and they just kind of can run rampant. But I would hope that that's the minority. And I think the majority of people that are being kind of forced back to the office are more upset at what you said, Greg, is like, that commute, the being stuck in traffic, having that extra 90 minutes a day that's kind of wasted. You multiply that over a year, they're talking, hundreds of hours of time spent just sitting,
That's having to get up an extra hour earlier to get your workout in if that's what you need to do, right? Because at the end of the day, or get your kids ready for school, come back, getting dinner prepared, like especially if there's two of you in the house and you're both in that situation, which many are. It's crazy. Did you see this? Stephen just posted up a message. Cam is Stephen's. Is that your wife, Stephen? Partner? Are you married, Stephen? Anyways, doesn't have enough seats for everyone. Excuse me. Doesn't have enough seats for everyone coming in 3 days a week. And people commute in just to have to go home again to work from home. What is this story? This is the headline. Whatever I just said isn't the headline. This is the headline. This is in the news. Now, that is a lot to take in. That even more irritating. Get out of here. Nowhere for you to sit and work. Now what? Yeah, an hour in, an hour back, and then just pissed. Zero productivity.
And
what a pint.
Yeah, so from the government's side of things, is the idea of having them go back to work to utilize obviously the office space that they're paying rent on, or is it more just from are they feeling that the productivity is down? Like, what is the actual? I'm ignorant to
all of the above.
Okay.
Productivity, using office space that's sitting vacant, revitalizing downtown cores in all areas across the country that haven't had that.
Yeah.
And just keeping tabs on people. Like really at the end of the day, some people are productive and then others that just aren't. And so it's kind of getting to that. So it's kind of all of those above. I mean,
we'll see how many new managers to manage the managers managing employees.
The manager of review managers
that the government suddenly employs.
We had a friend who, I won't name names, but he used to have a title that was manager of review management managers. So he had 3 managers in the title. It was so ridiculous.
Oh yeah.
The manager of review managers or something. The other thing I saw in the news was regarding student housing, that there's like a massive, they're going through every city. It was actually on the podcast I was telling you gentlemen about, the Canadian Real Estate Investor podcast. They were talking about student housing and how the need for it has decreased dramatically. Like it was basically, I think in some cities it was down like 60% or 70%, the need for student housing. And it's just, I think in general, because of obviously now the limits on the international students, I think the number of international students is funny. They had a number. It was like they showed the percentage of increase in international students. And then this year, the decrease in student housing because of the new restrictions that they put on. So for anyone interested, I would certainly advise you to go listen to the most recent episode of that podcast because they really dive into it. And it was a very good conversation. I'm butchering it. So I'll just...
do they dive or do they delve?
Everyone's going to be learning online soon enough anyways. That's going to be another problem, right? Woohoo. Yeah.
True.
Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction. At Geltin Poirier Avocats Lawyers, we love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you. For an effortless client experience that opens doors, call us at 613-744-4488 or visit our website at geltinpoirierlaw.ca. Let's get to the heart of your deal.
Are you trying to grow your mortgage business? Centum has the tools and support to help you take your business to the next level. Get access to everything from free unlimited custom marketing to daily direct pay. Find out what your business can do with Centum. Learn more at joincentum.ca.
Okay, what's next? We got that. Let's get into that stat piece that I kind of brought up for you guys to lead into. I don't have it in front of me even right now. What was that one? What was that? That's the townhome market analysis.
Yes.
You guys,
So we kind of put together a few scenarios. Greg, do you want to talk about kind of that market?
I'll just talk about this what I put together here for Dave and Paul to kind of give everybody an image of what's going on in terms of affordability. Now, if you're shopping in the townhome range, which a lot of people are, this is a breakdown of what is going on in the major urban, like in the suburbs in Ottawa. So like anywhere, Riverside South, Orleans, Barhaven, Canada, Stittsville, the suburbs and townhomes from 450,000 to 650,000. There's 244 properties currently on the market available. So if you don't think you have options, you have options. And we just want to kind of break down what that looks like in terms of numbers if you are looking to buy, and I'll let Paul and Dave get into that. Now, most of these are standard townhomes, 3 bedrooms, 1 car garage, 2 to 3 bathrooms, and most will have a finished basement. I will say that the one at 459 is in Castle Heights in the east end of Ottawa. They usually are less expensive or more inexpensive just because of the neighborhood and the community, but that's a crazy price, $459,000 for a freehold townhome, and it's not bad. And then the top is $650,000. There's 6 of those. The one that we have here is in Riverside South. So I'll let Paul and Dave take over just to kind of break down what this looks like for a buyer.
Yeah, so I kind of put together 3 different price points, 450, 550, 650. And I just put together kind of what the minimum down payment would be. And then also I did 10%. So from my experience, at least recently, most first-time buyers are putting somewhere between 5 and 10%, unless they have gifted down payments or what have you. So at the 450 price point, your down payment, your minimum down payment would be $22,500. So that's at 5%, being that it's under $500,000. So the mortgage on that would be $444,000. That includes $17,000 in insurance default premium. So that'd be a CMHC or whoever. I used a rate of 4.29 for a 5-year fixed and a 25-year amortization for all of these. So the payment on that, $450, 5% down, the monthly payment would be $2,409. And on the flip side, that same property with a 10% down payment, $450, down payment's $45,000, the mortgage is $417,000, $12,000 insurance premium, monthly payment $2,262.
It's amazing.
So a bit of a difference there. And then next price point, I'll go through these very quickly. $550, 5% down, or minimum down payment is $30,000 on that, because again, it's over the $500,000. So very quickly, under $500,000, it's 5%. Any dollar over $500,000 is 10% a minimum down payment. So in this case, it's $30,000. Mortgage is $540. Monthly payment on that for a $550,000 freehold home, $2,930. So under $3,000. And Greg, correct me if I'm wrong, but that's the average rent is around $2,700 to $2,800 on a townhome, correct?
For a nice townhome, yeah.
Yeah.
Anywhere from 26 to 29 right now, for sure.
So then flip side, 550 with 10% down is 55,000. Mortgage would be 510. Monthly payment 2765. And then the last price point we have was the 650, which is kind of the higher end of those townhomes. Minimum down payment would be 40,000 on a $650,000 home. Mortgage would be 635 after the premium. Monthly payment 3437. So just under 3,500 for 650 minimum down payment. And then if you put 10% down, it would be $65,000 down payment, 10% is 650. Mortgage would be just over 600 at 603. And the monthly payment on that would be 3268.
Okay, not including, I think it's important for everyone to know that these prices, these numbers do not include property tax.
That's
and
just
utilities.
principal and
You guys, you have to adjust that in there. I think that's a shock to some people when they get that mortgage number and they just forget that they need to include their property tax and utility costs in there, because that does add up. So, I mean, on these properties, let's just say, you're doing 550,000, your property taxes might be somewhere around 450 4,500, excuse me. So yeah, so $450 a month, or just a little bit less. So that, that 22 can come up to, $3,000 a month pretty quickly.
I'm going to do this quickly on the fly here while you're talking, Greg, but to give people a breakdown. So let's just take that $450,000 with the minimum down payment. And let's look at the rates, let's say a year ago at 529. The payment goes up to just under $2,700.
And I was even saying 529 is light. I mean, we were a year and a half ago, we were up in the mid sixes.
So that's
even
300
only 2 months ago that we were at 529. Yeah. We've come down pretty dramatically recently. But yeah, I think, and certainly when you're looking at those numbers, to your point, Craig, you can rent some of these places for, cheaper than what the mortgage payment would be. However, that mortgage payment is also encapsulating principal that you're paying down as well on that. So every month, a portion of that payment is obviously going to pay down that mortgage. So when you're looking at comparing, it's not, make sure you factor that in as well. And then obviously looking at what the historic appreciation's been in the market.
Yeah. I want to stick on rates for 1 second, because there's still a lot of people asking about 3-year fixed rates. And my personal opinion is that the 3-year fixed rate ship has sailed. Like if you haven't taken a 3-year already, to me, I think the banks are still pushing 3-year fixed because I think it's in the bank's best interest. But right now, like a 3-year fixed is comparable to the 5-year. And, if you took it a year ago, I think it was probably a good choice, because, you're going to be renewing in 2 years' time, hopefully still taking advantage of those lower rates. But the benefit of taking the 3-year, at least in people's minds, is that you're going to be able to renew earlier and hopefully take advantage of the low rate environment. Right now, we're in a rapidly decreasing rate environment, and the likelihood is that's going to continue probably into the spring. So if you're taking the 3-year now, I think you're going to be kind of shooting yourself in the foot, because you're going to get the same as you're going to get for a 5-year. And the likelihood is in 3 months' time, 6 months' time, we're going to be seeing those 379s, 399s, et cetera, probably sooner than that. So I think the 3-year right now is kind of a fool's game. I think you're kind of catching yourself in that weird pocket where in 3 years' time, you might, rates might be up again. You're going to be kind of catching that up cycle again. So in my opinion, if you're considering a fixed rate, I think 5 is the way to go right now. I think the 3-year is kind of that ship sailed, as I said. And there's still a lot of people asking about it. I think it's kind of being pushed by lenders, but I still think right now it's not the right time to take a 3-year fixed. Just throwing that out there.
Yeah, I agree. I think also it's important. We said it, you were talking about at the beginning, but I think people looking at the variable rate mortgages instead with the decreasing rate environment, like, what people aren't aware of, and this kind of rolls into our definition for the week. So it's a good segue, but is there's 2 types of variable rate mortgages. There's a variable rate mortgage, or a VRM, and there's an adjustable rate mortgage, an ARM. The difference is they're both, you're locking in a discount to prime. So you're typically getting a 5-year variable or 5-year adjustable rate mortgage. And you're locking in a discount to prime. So it might be bank prime minus 1%, let's say. On a variable rate mortgage, when you close on that mortgage, your payment is staying static at whatever that payment is on closing of that mortgage. So let's say right now, bank prime's at 6.45, your prime minus 1, for easy math, 5.45. On a variable rate mortgage, what the payment is at 5.45 is what you're locked in for the full 5 years. As the Bank of Canada lowers or changes, makes any policy rate decision changes, that rate will come down, but the payment will stay the same. And the amount that goes to principal and the amount that goes to interest within that payment will adjust. So it's a static payment. So this is what, TD Bank, BMO, RBC, CIBC, Desjardins, Alterna, a lot of the credit unions, a lot of the banks have a variable rate mortgage. There is a different one called an adjustable rate mortgage. You lock in a discount to prime, but as the rate changes, so do your payments. So hence the adjustable aspect. So banks like Scotia, for example, or what I call monoline lenders like MCAP or RFA or First National or any of these, they have adjustable rate mortgages. So as in a decreasing rate environment, it's important, I think, for people to look at the 2 differences and look and consider the adjustable rate mortgage, where, to Paul's point, kind of that ship sailed on the 3-year, you're trying to time, and we know that rates are coming down. While in both a fixed or a variable or an ARM, you can convert to a fixed rate at any time without any penalty. you also have the ability to pay out that mortgage at the most you're ever going to pay for a penalty is equivalent of 3 months interest. So what you can look at doing is taking an adjustable rate mortgage where you're riding the rates down and your payments are being adjusted and coming down as well. If you want to pay more, you can certainly voluntarily increase your payment, but it is giving you that flexibility that you can convert it to a fixed rate at any time at a later date as rates kind of come down. So I think that's, to Paul's point, either looking at if you want to set it and forget it, maybe looking at that longer fixed rate portion term. Otherwise, looking to the adjustable rate mortgage as a strong option, especially that the market, and there's a lot of talk of that 0.5 point drop the end of October, another rate decision in December. Like there's a possibility we see a 0.75 point drop between now and the end of the year. So kind of crazy comparing that between where adjustable rate mortgages are at or variable rate mortgages and what those fixed 5 and 3 years are at.
Amazing.
Yeah, it's great. Great definition, David. Very defined, refined, a refined definition. Yeah, and that's kind of what Dave was saying about the true variable, like the TDs. That's where we were seeing, I know I mentioned this on the show maybe 6 months ago, that client that had a 103-year amortization on his mortgage because he hadn't increased his payments, and the majority of his payment, almost all of it, was going directly to interest. So as the rates come down, those people that are in those kind of static firms are also going to see their amortization decrease, which is nice. So there are benefits. There's perks.
Mood boosts.
Mood boosts. I was just going to say, why don't we slide into the boosts?
Let's do it.
Let's see here. I got 3 today, and I think you'll like them. Number 1, what are a ninja's favorite kind of shoe? Sneakers. Sneaky.
I like that one.
Number 2, at my last job interview, they asked me, where do you see yourself in 5 years? I said, I think we'll still be using mirrors.
Amazing.
I like that one.
I like that a lot.
And the last one, number 3, did you hear about the cheese that's been working out? Dude's shredded. Threaded.
Fun fact, I'm reading a book about ninjas right now.
Nice.
It's
hilarious.
Actually.
Real life ninjas.
Yeah. I'm reading a book about the history of ninjas.
Wow. Love it. Well, thank you everyone for tuning in. Let us know. Give us your feedback, good and bad. Let us know what you want to hear, any guests you want to see. And as always, we'll be back next week. New episodes are released every Wednesday, 10 a.m. You can find us on YouTube. Make sure to follow our socials as well. We got some exclusive content on there, and we appreciate all of you. Have a great week.
See you next week.
Cheers.